Hey everyone, welcome back to another Meet Kevin report. We are on episode 75. Welcome back. First thing we're going to talk about is the IMF is now warning that the 5-year growth outlook for the entire world is likely to be the weakest that we have seen since the 1990s. This is in a piece via Bloomberg that apparently now the International Monetary Fund is warning and urging nations that basically they need to avoid economic fragmentation caused by geopolitical tension and take steps to boost productivity, because otherwise we're going to be as a globe doing way less well than we might otherwise. So let's try to translate that to English. Let's think about that. Really what they're trying to say is, hey, look, we've got massive issues across the globe. We've got a crisis in Russia that's leading to more of a partnership potentially between countries like Russia and Iran, Korea, North Korea, and China. Whereas we're getting that sort of fragmentation on the West, where at the West, maybe you have this desire of America to work with Europe, as usual, as well as Ukraine, but you have this fragmentation potentially occurring with South America. So, TBD. But point being, the the Bloomberg report really suggests that without strong global growth, we could have excess global poverty. And I think it's very interesting to think of economic growth from the point of view of all nations together rather than just America or just where it is that we are living. So I think that that is pretty remarkable and a pretty remarkable warning. Really, it almost uh, kind of reminds me of the days I talked about a frugal decade back in 2020. Obviously, with the amount of stimulus that we had received, there's no way there was going to be a set of frugal years ahead with the amount of money that was handed out and printed. But beyond that, potential for a frugal decade in the longer run could be quite interesting. This IMF report kind of alludes to that, where, I mean, think about it, you're really putting people through dual economic shocks. You put them through the shock of COVID and the psychological lockdowns of COVID, the lack of human interaction for what, a year plus, since depending on what state you were in. Maybe if you were in Florida, you never had that problem. But anyway, that's one. And then, of course, number two, whatever it is we're going through now, what if this recession is not just a 2-year recession where it's 2022 and 2023, but instead it's 5 years long. And I think that's something that a lot of us think that this recession will be quite shallow and quick to end. But unfortunately, no guarantees of that. So, we've unfortunately got some concerns from that POV that maybe there is more of a downside risk. Hopefully not. I don't think so. I still maintain my belief in the Nike swoosh. So we'll see. We'll see today if the jobs report can reiterate the Nike swoosh. That would be very nice. The jobs report is expected to come out within the next 5 minutes. We'll go through the surveys and expectations as well. As we'll see what is up ahead. I will go through quickly what Barron's is suggesting. So Barron's is suggesting that, quote, a jobs slowdown could be here. Let's go ahead and share the screen with it, and we can look at it together. So let's see here. We will present the extra camera of the iPad. Okay, look at that. Fantastic. Fantastic. All right, there we go. And there we go. We'll throw life insurance up. Okay. Job slowdown could be here. What to watch for in today's jobs report. So that jobs report is coming out in about 5 minutes. Of course, we'll be going through that in detail. But let's see what we have here. Jobs growth likely slowed in March as rising interest rates, persistent inflation, and growth fears weighed on employer demand for workers. A slowdown could mark a step towards normal levels of growth for the US jobs market, which has been exceedingly tight for more than a year. But it could also underscore that job creation remains remarkably healthy, even as other aspects of the economy slow. So the expectations are that we've added 240 jobs, 240K jobs, 1,000 jobs. That is the consensus, the fact set consensus. That's down from the 311 consensus, and certainly down from the 311 consensus is the pace that we've been on rather since December, and it is down from that crazy over 500,000 read that we got in January. Economists also expect the unemployment rate to hold steady at 3.6%. So we'll see. Investors and economists have been expecting to see signs that the economy has begun to deteriorate since the early March collapse of Silicon Valley Bank and Signature. While the jobs report for March will be closely parsed for clues as to where the labor market was heading, it is unlikely to show what impact the banking turmoil has had yet. Yeah, that's true. I think there's a lot of fear that the turmoil has done a lot of damage to our economy. I'm not convinced of that. I'm not convinced that the banking turmoil is necessarily that tragic for our market. I wonder if the banking turmoil could be a little bit more of a this is uh, this is what happens when rates rise quickly, and the riskiest of the banks unfortunately get whacked. And those are the risk mitigation measures that each of the companies need to implement themselves. And those were the choices that Signature and Silicon Valley Bank made. And unfortunately, they paid the price for it with the loss of a lot of their share value and potentially their jobs. So we'll see. We will see. Everybody looks at it a little bit differently. Everybody thinks every single bank should be impervious to any kind of failure. I disagree with that. It's entirely possible that Yellen and Jerome and Biden did the right thing for financial stability, but I'm not terribly convinced. So, anyway, let's take a sip of coffee here and prepare for the jobs report coming out in 2 minutes. All right. They're trying to push CBDCs where they can freeze and claw back your value. I disagree with that, and I appreciate you being a channel member, but in fairness, I disagree with that. I think CBDCs will come, central bank digital currencies, and I don't think they're going to be that big of a deal. I think people are making them out to be so much more of a big deal than they are. I don't think they're going to be any different, really, than the U.S. dollar. I mean, in theory, if they wanted to, restrict your access to the dollar, they could do that as well. They could seize your bank account, just like they could potentially do that. So I don't see how this is very different than you having cash in a bank. So I don't know. And then people are like, oh, but what about privacy? It's like, well, really, like that privacy. Isn't a problem as well already with your credit card and your bank data. Like, I just don't see the convincing argument as to why a central bank digital currency is different. Yes, you can get paid in cash, but you could still get paid in cash in the future too. Nobody's saying cash is going away. They're just looking at it as a supplement. So I'm not convinced of that. It'll take a little more time to convince me on that. All right, let's get into this jobs data. All right, we are 30 seconds away from jobs data. Change in non-farm payroll is expected to be 230,000, down from the prior of 311,000. We are looking for private payrolls to come in at 218, prior 265. Most important, average hourly earnings, expecting it to come in at 0.3. And here we go. Okay, we got 236, a little above expectations. We've got 0.3 for the month over month average hourly earnings. Average year over year earnings, 4.2. So I would say 6,000 more jobs than expected on the headline read. That actually dropped the unemployment rate. The unemployment rate fell to 3.5%. This is good. The labor force participation rate jumped up to 62.5%. All right, so this is not a bad report. It's not a fantastic report. I'd say it's a moderate report, which is actually kind of potentially good, what you want right now, because you don't want a horrible report suggesting we're about to go into the hell of 2008. Right? We've already got S&P PMIs and ISM PMIs that came in yesterday, slightly recessionary, and people are starting to get fearful that, what if we're walking into a recession? We need to be careful here. So we have to be careful what we wish for, because if we keep wishing for a recession, then maybe exactly that's, or weak numbers, then maybe that's exactly what we're going to get. Now, the stock market is closed today, so measuring the response will be a little interesting, though I think we do have futures open. So what is interesting here is this is a stable report. However, it does show that decelerating trend. Again, we were at 311 last month. Now we're down at 236. The fact that surveyors were within 6,000 jobs is actually pretty impressive, given that usually they're much more wrong. The average hourly earnings coming in at zero point 0.3 as expected is fantastic. That's a sign that we are stable. There is no wage price spiral. I've been pounding the table on about no wage price spiral for about 6 months, though, now. So I think this is just sort of reiterating that. Headline inflation for wage data at 4.2. So that's still healthy growth for wages, but by no means is it a sign that we're having this sort of runaway inflation, which is a good sign. We do not want to see runaway inflation. Let's now go ahead and look at the actual report itself. So we've got the actual report right here, and let's see what we're looking at. So this is the employment situation. Keep in mind, this video is brought to you by Shortform. Go to meetkevin.com/shortform to get super powered book summaries at Shortform. It's very, very cool. Check them out at shortform.com/meetkevin. Total non-farm payroll 236 in March. Unemployment rate little change. That is down at 3.5. Both the unemployment rate and the number of unemployed persons at 5.8 million changed little in March. Little net movement since early 2022. Among the major worker groups, Hispanic unemployment decreased to 4.6%, essentially offsetting an increase in the prior month. The unemployment rate for adult men was 3.4, adult women 3.1, teenagers 9.8, women 3.2, blacks 5, Asian 2.8. You've got permanent job losses did increase by 172 to 1.6 million in March. The number of re-entrants in the labor force declined by 182,000 to 1.7 million. So fewer re-entrants into the labor force. That's potentially a sign that you're seeing fewer new hiring. Re-entrants are persons who previously worked but were not in the labor force prior to beginning their job search. The number of long-term unemployed, those jobless for 27 weeks or more, was a little changed at 1.1 million. Okay, so little change in the long-term unemployed. So despite all of those massive layoffs we're seeing, not seeing a large tick up here in the long-term unemployed. But then again, the job losses that we've been seeing have really only just started occurring. So it might be too early to see a change in the long-term figure here. Okay, then we've got labor force participation rate continue to trend up. This is good. This is a sign that more people are potentially coming off retirement or off of unemployment checks, right, or welfare, and they're basically re-entering the labor force, which is good. Although there are work requirements for some of these jobs, COVID has really made it easy to not work. The employment population ratio edged up a little bit. Okay, fine. The number of persons employed part-time for economic reasons was essentially unchanged. So part-time unchanged. I'm really looking for differences here, inflection points. The number of persons not in the labor force who currently want a job, little changed at 4.9 million. Fine. We're also going to get Wall Street's reaction here in just a moment to these numbers. Again, so far, I'd say these numbers are pretty benign. They're not a sign that we're in a recession, and they are reiterating no wage price spiral. I personally actually think that is the best case scenario that you could wish for. You don't want something terribly off expectations, because then it also casts more doubt on economists' ability to do their job, which people already have little doubt in anyway. You just don't need to amplify that even more. 1.3 million here for those marginally attached to the labor force, also little changed. The number of marginally attached to the labor force, or discouraged workers, basically, little change, 351. Supplemental data. So the non-farm payroll increased 236 compared to the average monthly gain of 334 over the prior 6 months. So that gives you a sign of some weakness in trend. In March, employment continued to trend up in leisure and hospitality, government, professional and business services, and healthcare. We'll look at the tables in just a moment. Look at that: leisure and hospitality, hotels, resorts, skiing, restaurants, whatever. Up 72,000 jobs in March. That's lower than the average of 95,000 over the prior 6 months. So you are starting to get a little bit of weakness in this, finally a little bit of maybe turning over, a little bit of softening in the jobs data, but not depressive numbers of jobs data. That's good. Employment in leisure hospitality is still below its pre-pandemic levels by 368,000. And remember, that's below levels. That's not below trend. That's important. Think about that when they say that. And I think this is a very important perspective. And my goal on this channel is always to teach perspectives. That's why I have entire courses on building your wealth for teaching perspectives. So when we have jobs data that shows, oh yay, we have jobs growth, and then we have this big decline in jobs data. I accidentally unplugged that. And then all of a sudden we get back to slightly below the level where we were, right? So we're about negative 300, what was it, 80,000 jobs or something like that. Well, that might be almost back to 2019 levels, but what it's not is back to trend levels. See, at trend levels, you're probably down about double that. You probably still have another 800,000 jobs to go. Last month, we were down still about 900,000 jobs below trend for leisure and hospitality. Healthcare is just back to 2019 levels, and also below trend. So, okay, let's keep going here. Government employment increased 47,000. So the government is employing. I'm actually surprised that you have labor growth over here in professional and business services, up 39,000. That the trend here is about 34,000. So slightly above trend over here in professional and business services. Slightly surprised by that. Daniel Dickinson here says he's been laid off twice in tech, once in 2008 and once in 2020. Yikes. Sorry to hear that. It's always tough. Layoffs suck. Healthcare added 34,000 jobs, lower than the trend of 54,000. Social services continued to trend up, 17,000 in March. In March, employment in transportation and warehousing changed little, 10,000 over here. You got a lot of tension over here in warehousing. Oh, that's actually very interesting. Wait a second. Warehousing and storage lost jobs. Wait a second. That's actually a really big deal because wow, remember what we read yesterday? Yesterday, we started reading about this, and that was that as the economy weakens, I'll give you the quick synopsis on this, the state of freight. As the economy weakens, what happens is more companies leave their products sitting in warehouses, and now warehouses are full. We made this analogy yesterday of the farmer basically filling up their silo, and they could basically have a supply glut, a lot of supply, and not put that on the market because they're filling up their silo. But now the silos are full, and the prices for new warehousing are going up. And so, what happens with a lag? Well, what happens with a lag is you get a dump in prices. People start dumping their supply because they don't want to store it anymore. Well, what did this jobs report just do related to that? Well, this jobs report just told me this: warehouse and storages lost jobs. That actually reiterates the idea that there is a lag in storage, in deflation, basically in product deflation. Let me simplify that here. So if I write this down here, I'm going to say, if let's set some conditions. If we have supply rising, then you'd assume warehousing would also become more expensive and more would be hired in warehousing, right? Let's make that a little smaller here. There we go. That is what you would assume. You always have to be careful with assumptions because you know what assumptions do, right? They make an ass out of you and me. Anyway, so this is interesting because if we have more supply, then there's more warehousing demand at first, but at some point you face an inflection. And the inflection is where people basically protest and say, you know what, instead of storing even more, I'll just dump at lower prices. Why is it when I touch this? It's something so sensitive. There we go. You have this dump at lower prices. Now, that's actually very interesting because it suggests that we could be seeing more price reductions sooner than we expect. What did we just get at Tesla? We just got 2 in a row price reductions on the Model S and X. Now, I personally take no responsibility for that, but I will continue to bag on the Model S and X. I do not think they are worth it. Am I really nervous about that they've dropped prices on those twice? No, not at all. They don't really move the candle compared to the Model 3 and Y sales. But it's a sign that this is what businesses do. As inventory piles up, you cut prices. That's totally normal. And seeing now a softening in warehousing, that is actually just what we want to see. That's exactly what we want to see to suggest that deflationary prices are coming. So I'm excited about that. Okay, let's continue on here. So warehousing, a little change, or well, slightly negative. They're calling it little changed. But again, it's also not skyrocketing because people aren't building new warehouses. Employment in retail trade has little changed, negative 15,000. Job losses, building material, garden equipment minus 9,000. Furniture, home furnishings down 9,000, partially offset by job gains in department stores plus 15,000. Retail trade employment, little changed over the year. Employment showed little change over over the month in other industries, including mining, gas extraction, manufacturing, wholesale, and otherwise. Here's that average hourly earnings, 0.3%. That's very good. Average work week for all employees edged down. It's good that we're not seeing a massive plummet in this, but I will say this average hourly work week, this has been teetering for months now. It's been up and then down. It's been up and then down. So I really don't see it as that big of a deal to continue to look at the average hourly hours week, average hours worked in a week. Don't see that as that big of a deal, bobbing up and down a tenth here or there. That could honestly just be survey based. So let's see if we can get into some of the tables and see what we have for these. And if we can get a little bit more granular into the data, I do think overall this is an optimistic report. Let me see if how the bond market is reacting to this. So if we jump into the bond market, we're looking at, let's see here. Okay, we've got Dow futures. Basically, the stock market's flat. Dow futures up about 0.1%. Nasdaq futures up 0.9%. S&P futures up 0.09%. You've got Nasdaq futures basically flat at 0.04%. Now, you might be wondering, wait a minute, Kevin, how are futures up when the stock market is closed? Well, folks, the stock market might be closed, but that doesn't mean future traders are weenie babies who take every day off that they want. I'm just kidding. I don't want to offend the stock market people. I actually really like the stock market, folks, and I really don't do anything with futures. So what am I doing here? I'm like betraying my side. I'm supposed to enjoy your day off and your time with family or something. I don't know. Go enjoy Easter or whatever it is you celebrate. I don't know what else happens in Easter, Passover. There's other stuff. Anyway, okay. So that's the and I appreciate you being here either way. Okay, that's the bond. Okay, wait, sorry. That's the stock market. Let's look at bonds. So bonds actually rising slightly. So you've got the 10-year popping up to about 3.355. Now that's actually a good sign that we're sitting closer to stability rather than a recessionary impact, which that's very good. So I like to see that. We do not want recessionary. Now, let me see if 5-year break evens have modified at all, and then we'll get into some of the tables here. So, 5-year break even. All right, 5-year break evens so far are sitting roughly stable, although they may give me an update here within the next 2 minutes here. So far, those stable. But let's go ahead and look at some of the charts that we have, shall we? So in order to do this, we are going to click a few buttons here. There we go. Button number 1, button number 2. Fantastic. Fantastic. All right. So this gives us the unemployment rate. Let's go through some of these others here. Let's look at the household survey as well, just to compare. Actually, that would be a good idea. Let's jump over here. Let's look at what the household report is saying today. So, household data. Let's see. The household. They don't show us the actual number. Where's the number? In the household data. Okay, I'll have to go to the table alpha for that. Okay, no problem. I will do that. Stand by. Let's get back in over here then. All right. So let's see here. They don't break it up as easily as you'd think here to get the difference between the household and the payroll survey, but I will grab it. I want you to keep in mind the difference between the two. The household survey is when they call actual individuals, right? They call individual people and they say, "Hey, are you employed right now?" And if you have multiple jobs, you're just counted as one person. Whereas the payroll survey calls businesses, which does create a potential for double counting individuals. And if you double count individuals, then you might have a little bit of a misleading result. So it looks like the household survey moved. Wow, that's actually a pretty large move here. The household survey went up 577,000. So 577,000 move in the household survey compared to a 236,000 job in the job move in the payrolls data. This is likely because the household survey has been very volatile and trying to play catch up to the actual payrolls survey. So I don't necessarily see that as bad, but it is substantially higher than the 177 we had for households last time. And then a little lower than, well, actually a bit lower than the 894 we had in January for the households. So I think you are seeing some of that households catch up. Oh, that's not very entertaining. What is you? There we go. Let's get back to some charts over here. Silly, silly HDMI cables. All right, let's keep going here. So let's look at this. So we can take a look at some charts. I want to see particularly if there are any interesting ones here. This will give you the average hours worked for different groups here. I'd love to see if we can get a little granular in this. This is manufacturing. So we could see manufacturing hours worked declining off of those peaks that we saw in 2021. That's good. Durable goods, nice decline there as well. Those are going to be like appliances or other equipment. Let's try computer and electronic manufacturing, also rotating down. Let's go with apparel. Apparel actually up. Look at that. Apparel manufacturing at a high right now. Shout out to those Nike and Lulu folks. Paper manufacturing. Do we really care? I mean, we're not printing money anymore, so that number's going down. Let's go with machinery manufacturing. We're down on machinery manufacturing. How about appliance and electronic equipment? Also rotating down. And then furniture over here. Let's see. Furniture. I make it a little challenging to use this chart. There's furniture. Seems roughly stable. All right. Any other particular employment? Let's try employment by industry. Let's take a look at this chart. All right. So let's jump into construction. Okay, and let's take away the totals. There we go. Look at that. Construction, nice rise here. Been very consistent, maybe just topping out there on the right, maybe a little bit of a topping out. Leisure and hospitality, just so you can see the trend. That is a terrible color. Also, nice trend directly up. How about professional and business services? Yeah, a little bit of a lower, slower inflection point there, so a bit of a slowdown. Financial activities. This is where you're really seeing the a little bit of the slowdown. You're actually getting that negative inflection point. All right, let's get IT, information technology. Information technology also seeing that inflection to the downside. Let's get how about just government in general? It's not too useful. Let's take a look here. Not very useful at all. Okay, manufacturing. And let's get rid of government and financial activities and just look at manufacturing. Okay, we can't. Let's try again if we do this. There we go. There's your manufacturing. Also hitting sort of a resistance level there, if you will, on manufacturing. Doesn't seem like construction is hitting that level, though, is it? Barely. I mean, maybe just beginning. But I think the charts are somewhat useful in taking a little bit of a glance at what's happening. So let's take a look at some of the Q&A that we have. I want to see what y'all are thinking here. Tesla nominates former tech chief Jerry Strubble. Isn't he also on over at Redwood Material? I think so. So let's see here. While not our favorite scenario, could there be a silver lining with stagflation? I actually think this is potentially a good scenario, that this is I would not call this an unfavorable scenario. I'm optimistic about this. This is an at expectations read. I mean, look at what we have: no wage price spiral, as we've been reiterating, and optimism around maybe the economy isn't doing that horribly. I think as investors, a lot of folks right now are of the mindset that we are likely to be looking at a terrible economy and another 2008. That's certainly a concern that a lot of folks have, and we'll go ahead and look at some other reports as well. But yeah, I'm not that pessimistic. Maybe a developer. Let's see. Yeah, developer you built on a swamp last fall. Yikes! I guess everything in Western Florida is built on a swamp, though. So, okay, so I think that does it for our job segment. Let's go jump into another piece, and this piece that I found I thought was quite interesting. It talks about this idea of the next cycle being quite different. Also, let me see something here. Trying to see, folks, is there on your screen a flicker on the camera? Just curious if there is a flicker on your screen for what you're seeing. And then let's get into some other research and headlines. Okay, so let's get this in here. 1 second. Transition over. Okay, now. So we're gonna call this cycle is different. No flick. Oh, good. Okay, fantastic. Then it's just on the preview that I'm seeing, which is quite annoying, but that's okay. Let's jump on into this cycle. Thank you very much. Appreciate y'all. All right, let's go into this piece. Next piece here. So the next piece is right over here. Push this button and this button. Well, folks, in this next piece, we got to talk about this T.S. Lombard argument that how is this cycle different? And every time we hear this time is different, we want to be nervous. But what they're actually saying is tech. That's the only thing that's different about this cycle. What they discuss is this argument that this cycle is different because in every down cycle, there is a poster child for what got overbuilt, distorted, and basically bubbled up. And this time, T.S. Lombard argues it's tech's turn. It happens every cycle. An industry convincing themselves and investors that they are a growth industry immune to economic cycles, and then discovering they are, after all, a cyclical business, which means you are affected by the business cycle after all. Commercial real estate here is potentially another obvious problem and a coming issue for banks, given that banks hold 50% of commercial mortgages, specifically the smaller ones relative to the smallers. The larger banks hold about 7% commercial mortgages. It's the smalls and medium-sized banks that have more of exposure here. As far as inflation, high prices, as opposed to the rate of change needed to reverse some of the items for consumers to gain lost spending power, blah, blah, blah. Okay, if not, so let's make this clear. As for inflation, high price levels, as opposed to the rate of change, need to reverse for some items for consumers to regain lost spending power. In other words, what they're saying is this time, in this recession, tech is potentially most exposed to a tech crush. Now, it could be argued that that's already happened, but they're saying that even if inflation goes away, prices are now so much higher, right? Remember, if you paid $100 for a piece of tech that now costs $120, you have experienced 20% inflation over a certain period of time, be that 1 year, 2 years, 6 months, whatever. And if inflation now goes away, you're still at $120. You have a 0% rate of inflation, but you're still paying more money. What does that mean? That means individual people have had their purchasing power, their pricing power reduced. And in order to regain pricing power, you might need to see wages go up. However, we're not seeing wages go up in the form of, say, a wage price spiral. And if we are not seeing wages go up and prices are higher, then people can simply afford less. stuff. Now, an argument is being made that today we have plenty of excess savings still. Yes, it is true that not only do we have a lower savings rate now than we did before the pandemic, that is true, but we have a higher base of savings. Remember what Bank of America told us last month? Somebody with $5,000 in their bank account before the pandemic now sits somewhere at 12,900 to $13,900 of extra cash. But what happens when that is spent? Are we in a deep, dark recession? Or have we finally conquered inflation? Jerome Powell's done with his rate hikes, and we can go back to the glorious bull run of the 2010 to 2019 cycle. Some people say that's delusional. Other people say, no, that's actually entirely what could happen. But let's see what T.S. Lombard argues. The coming reversal in credit expectations will also help lower inflation by pulling down service price inflation. So, in other words, less credit, less service inflation, great. But what they see coming will be a downturn with a recession that ends up correcting the excesses of 2010 to 2019, specifically tech and asset values, not simply a correction of the post COVID boom. Now, this is fascinating because this is actually a Peter Schiffian argument. Peter Schiff has argued that we are not going through a crash of the COVID money printing. We are actually repaying the debts of the bubble we created post 2008. T.S. Lombard is now echoing the Peter Schiffian argument. And folks, that is one that should create nervousness. Now, how could asset values go down? Well, let me make this argument in regards to real estate. So, a lot of people, obviously, you know this already. Well, most of you do, but some people don't. Obviously, for those of you who don't, I'll explain. I'm a licensed financial advisor, but I started in real estate. That's very rare. It's very rare that you have somebody go from real estate brokering to financial advising. This video isn't personalized financial advice because, of course, I don't know you. But when I look at this, I think I try to look at what's going on in the economy from both sides. I try to do the same thing in politics as well. It's very difficult because obviously divisive videos do much better. But what I think is fascinating is this potential that real estate may not necessarily rebound immediately if rates drop. We have this expectation that the bull run of real estate will continue if interest rates drop. But what might also happen if interest rates drop? The people who have refused to sell might think, oh, well, interest rates are lower now. Now is a good time for me to move and sell my property. Or maybe I'll get a higher price because interest rates are lower. But if everybody thinks that, inventory bubbles up. And you could actually then have substantially more inventory than you previously had in the last 8 years, frankly, certainly during the pandemic. And if you have to adjust to a higher level of inventory, then it doesn't matter if rates go down. You could actually see a real estate crush. And you could see that same real estate crush in residential, which could just be amplified by a similar crush that you see in commercial real estate. So I think patience in real estate is very prudent right now. Don't get me wrong. My goal with my real estate startup is to create a 10 to 100 billion dollar company with HouseHack. I could not be more enthused about the path and trajectory we're on. So I'm very excited about that. But I am also having to be very cognizant of where are the potential black swans individuals aren't paying attention to. So I run those scenarios through my head. And this T.S. Lombard piece evokes some of those potential fears. Now, that's not to say it's FUD, fear, uncertainty, doubt. This is a real argument. So, as Daniel here says in the chat, patience is a virtue. I completely agree. And maybe it could be considered a normalization, right? All right. So there's a little bit of a preview they give here on jobs, but we've already gone through the jobs data, mostly at expectations here. Now, I think this is very interesting. They show a confirmed weakness in white collar hiring, and they use this to basically say, while the tech sector is far from being relative to the entire economy, remember, you could lay off the entire Silicon Valley Bay Area and only affect 3% of jobs. So while the tech area is far from being relative to the entire economy, it has been on the margin an important driver of overall growth, hiring, and spending, and a source of income from the financial sector as well as investment wealth. When the tech sector booms, you have people who build their wealth. And when people build their wealth, what happens? People can spend more on services or going on holiday, going on vacation, right? Holiday. Sorry, I was talking to some Europeans yesterday, and that's how they say it. I am, after all, a European. I was born in Germany, but I consider myself an American. I've been here since I was, 13 months old, somewhere between 13 and 18 months old. Nobody seems to know. Anyway. Tech employment increases 60% since 2009. Look at that difference. That actually gives you a showing here. Look at this. Two things here. Non-public tech firms net worth versus non-financial corporate tech x real estate. So non-financial corp. This is a little bit confusing. Let's look at this chart instead. I'm not going to try to understand that one here live. We'll understand this one together. High tech versus the private sector, excluding leisure and hospitality and social services. So that would be private sector jobs could be like manufacturing, PC repair. To some extent, that could be really any local business that is outside of tech. And what you're finding is this large wedge here between 2009 and 2022, where you've seen a boom in hiring for tech relative to other sectors. Commercial real estate, an obvious problem, notably the leverage and large offices. Yeah, and we realize this already, that JP Morgan just mentioned the other day that we could be seeing a $350 to $400 billion hit from commercial mortgages. I was just talking to another financial advisor yesterday, and they see a potential. They see BlackRock liquidating a substantial amount of mortgage-backed securities, and the liquidation of that could lead to the selling of a substantial amount of real estate assets. We shall see. Commercial real estate debt has been less of a problem than it was in the 90s commercial real estate recession over here. So you have less of a problem out here in terms of commercial mortgages outstanding in total. And then you could see that commercial real estate held by banks has been slightly trending up versus non-banks. The large banks have been heavily moving into commercial real estate, whereas the non-large bank lenders have been helping people with 30-year fixed rate mortgages. These are going to be your mortgage brokers, your direct lenders, your UWM, your Rocket Mortgage, and otherwise. Dollar's downward impact not finished yet. I actually believe that. I think that the dollar is likely to continue to fall, and that's why I started by taking a short position last summer in the dollar. And I'm not short the dollar right now anymore, but I do think there's still some move down potentially in the dollar, specifically as yields fall. Remember, as yields fall, people's desirability or interest in the U.S. dollar declines. And that's because we need the dollar in order to buy quote unquote safe assets like treasuries. And so the more yields are high on our ultra safe, potentially the safest asset in the world products, the more we end up with a demand for our dollars, and that drives our dollar up. So now is take a listen over to CNBC. So we'll close off this section here. Let's do a summary, I suppose, on TS Lombard. I guess the summary here would be, is it possible that if we combine this summary, let's think about it this way. Combine this information from TS Lombard with what the International Monetary Fund said this morning, that we could be going into a 5-year slowdown. And what do you face? Well, you face an environment where potentially you could have a repayment recession of the bubble of 2009 to 2010's bull market. And you could have a 5-year slow blow recession with a real estate slowdown over the next 5 years. And in my opinion, the next 5 years, if we have a slower recovery and we do not simply resort back to the excesses of the 2010 to 2019 cycle, I believe the next 5 years would actually be a glorious opportunity to build your asset base. Think about it. What you want is your assets to be massive in the future. And if you potentially invested in, let's say, pricing power stocks today, which got us through the next 5 years, and then we went back into a bull run where credit started expanding again rather than tightening, and real estate really started recovering again, maybe you could set yourself up pretty well by working hard over the next 5 years and making sure you have as much available capital. Now, that's something we regularly talk about in the course member live streams, which I encourage you to check out. Link down below, you get lifetime access to those courses on building your wealth. And of course, you can use the coupon code that next expires, which means the price will be going up on the 12th of April, which is a week from today, when we will be covering. Actually, it's not a week from today, it's actually only 5 days from today, when we will be covering the CPI release. And that's why we're creating the honor of the CPI coupon code, 69% off. Prices did tick up a little bit from the last time, and they will tick up again after this coupon expires. And you can now use Buy Now, Pay Later to join. All right, so that ends this segment on potentially this, what should we call it? The IMF bear market. So IMF bear market. Let's take a listen to see if CNBC has any coverage today, given that even though the market is open, I expect they will, but they seem to be on commercial right now. So let's see if the suits have anything to say about this jobs report. 5-year break-even index still holding stable. So that somewhat implies stability. Market, okay, here we go. Friday's employment report ended up coming in pretty close to published consensus. While a weak number would have cemented the end of the Fed's tightening cycle, this figure keeps the door ajar for another hike, particularly if the CPI report surprises to the upside. Yeah, I completely agree with that. I agree with that. Let's see how the treasury yields are holding up now. NASDAQ futures, even though the stock market will be closed today, positive. And if we jump over to bonds, we're up about 6 basis points on the 10-year. So relative stability. I'd say that's a good thing. All right. And I don't think CNBC actually has their show up today. So we won't be popping up over there. Let's do a slight bit of Q&A here with the blue chat and green chat group. By the way, you could be in the blue chat group if you're a course member. You get those in the course member live streams. What about renters being evicted? Yes, that's entirely a possibility that we could go through an eviction cycle. Absolutely. I wasn't a homeowner over the time, but I believe it was zero interest. They just tried to, let's see, you're talking about deferments. Yeah. Now, I'm not so worried about the deferments for mortgages, given that people can now adjust into potentially a 40-year mortgage to make sure they can stay within their homes. A lot of people are pretty frustrated by that, but personally, I actually like the 40-year mortgage. We could do a piece on that. Yeah. How can we structure a piece on the 40-year mortgage? Let's see here. Sorry, I need a better table so I can have a place to put this microphone. Let's see here. Can I do this? No. Jerks. All right, let's try why. Yeah, generally, it's difficult to calculate a 40-year mortgage because most calculators don't go to 40 years. But I can make one really quick. And then we can talk about it. Let's grab just a regular template and then adjust it. Okay. Let's see. Got it. Okay, so the 40-year mortgage would be times 40 years times 12, 480 months. Okay. Mortgage length. Heh, got it. Okay, fantastic. Actually, this does sort of let me play with it. Oh, that's fantastic. Fantastic. Okay. Interest. All right, let's play with this because it should be pretty fun. Monthly data. Cumulative interest. Yeah. Oh, I love these charts. Okay. Let's do this together. Okay, stand by. There we go. 30 seconds here. Okay. So recently, there's been a lot of trending talk on none other than Twitter about the 40-year mortgage. And basically, people are starting to circulate this conversation over, oh my gosh, people are going to get 10-year car loans and then they're going to get 40-year mortgages. What's next? 100-year mortgages? 20-year car loans? Heck, you know what? Let's take the logical fallacy of the slippery slope argument and say we're going to have a 30-year fixed rate mortgage on a car. And that car, which is a Toyota Camry, is now going to cost you $200,000. Well, folks, generally, I despise Twitter. It has nothing to do with Elon Musk. Obviously, you know I'm an Elon Musk fan. It has to do with the fact that generally, the highest quality information on social media falls to the bottom, whereas the most invigorating and emotionally creative byline is what gets everybody's attention. It's the same thing on YouTube. I mean, you should know this by now. The headlines have to be jazzy and snazzy, otherwise, people aren't interested. If you don't have a snazzy headline, nobody clicks, and then nobody can get the perspective that actually matters. For example, yesterday, and then we're going to talk about this 40-year mortgage. For example, yesterday, I suited up and I went on mainstream television. I hopped on none other than everyone's favorite channel on the left and everyone's hated channel on the right, Newsmax. Okay, obviously, I purposefully flipped that. But yeah, I went on Newsmax. I talked to Sean Spicer. He's talking to me about the falling of the dollar because that's more clickbait that's going on right now. And I'm like, dude, if you're buying assets, it doesn't matter. And they're like, wait, we didn't even think about that. You're saying we could just buy real estate, stocks, bonds, or gold, or whatever, some kind of asset, and then not even have to worry about what our asset is denominated in. Yes. But you don't generally find that headline or that byline because it's not sexy. So, anyway, as much drama as there is going on around this 40-year mortgage, the 40-year mortgage for a real estate perspective would actually be a godsend for real estate investors. Specifically, not for big corporate landlords, because big corporate landlords are not going to get access to these 40-year mortgages. Specifically for you. So let's take a piece out of the playbook of the Zero to Millionaire course on building your wealth, right? Why do I have a course on building your wealth, the Zero to Millionaire? Well, I do. There's a coupon code linked down below. You can now use Buy Now, Pay Later for, because I truly believe that every one of you can become a millionaire through real estate. You have to buy property and hold property. Now, generally, what people do is they go to a mortgage calculator and they say, well, but Kevin, if I take a 40-year mortgage, I'm going to pay a lot more interest over time. And that is true. Let's go ahead and do a little calculation and see how much more interest you would be paying. And then let's talk about maybe why this just isn't what it seems. So let's grab a share screen here, specifically on this mortgage calculator. And what we're going to do is we're going to calculate first the difference in payment between what we would expect for a 30-year mortgage, but then also what we would expect for a 40-year mortgage. And we're going to compare total interest paid. And then what we're going to do is we're going to ask, okay, well, why would we ever want to pay more? Why would we do that? We would want to pay less, right? Isn't the goal to minimize the amount of interest that we're paying? And the answer to that is not necessarily. It depends on what we are doing with our currency otherwise, with our cash. So let's go through some of the numbers here. So, first, some of the numbers. Let's look at a $350,000 purchase price. You know what? Let's bump that to $450,000. Let's get with a more normalized house here. And let's go with a more normal interest rate. Today, obviously, we're probably looking at about a 6.5% interest rate. I generally don't advise buying right now, and I don't think anybody actually expects we're going to see a 6.5% interest rate for the long term. So let's go ahead with what I dealt with a lot in 2000, or saw a lot in 2009 and 10 when I started in the real estate business. Bottom of the market, basically. And the market was still falling when I got in, so we were trending towards the bottom. 4.5%. Let's assume that you're not going to buy until rates are 4.5%, or your average is going to be 4.5% if you buy now and refinance later. And let's do a typical 15-year mortgage to go extreme here. Your payment in this scenario with 10% down on a $450,000 house, 4.5% rate, is about $3,100. Now, that is not your total payment for this property, because remember, your total payment is actually going to be made up of something known as PITI. So that is going to be principal, interest, taxes, insurance, and then if you have the pleasure of also having HOA dues, you can throw those down. So just put PI right here, and usually I separate P and I, but just to make things a little easier right now, we'll just grab the total right here. And then we're going to go get our taxes. And unless you live in the state of Texas, you're probably going to be sitting somewhere around 1.2% on an annualized basis. So we're going to divide that figure by 12. There we go. And let's make sure we have our parentheses in the correct places. There we go. Now, here's the magic of this little fun hack. Your property taxes on a monthly basis are usually just the purchase price minus 3 digits. Yeah, mind-blowing hack there, eh? I love little hacks in real estate. I teach endless hacks in the real estate 0 to Millionaire course, link down below. Okay, then insurance. Let's go with about $75. Now, obviously, this is going to get adjusted if and let's say you have no HOA, because everybody hates HOAs. Let's say you are not, in a flood zone where your insurance could be $275, and let's say you're not in Texas where your property taxes could be doubled. So the point of this is your payment for this property is now $3,623. Now this is actually a little bit problematic, because if we want your front end ratio, don't worry, you don't have to know what that means. If we want your front end ratio for this property to be 30%, you know what? I'll be generous. I'll go with 35%. Well, then your monthly income, before we even consider any of your other debts in your debt to income, your monthly income is going to have to be somewhere around $10,300 to afford this property, or $124,000. And this also assumes that you have saved up about $45,000 plus closing costs. So you're probably going to be sitting somewhere around $50,000 down. Oof. Okay. Well, that's going to be a little bit of an oof, eh? Because not a lot of people make $124,000. But your total interest paid over the life of the loan in this scenario would be, let's go over here, 180. That's your 15-year. Your total interest paid would be 152.6, and your total principal payment would be 405. So let's add 405 plus 152.6. Your total paid for this home would be sitting at 557.6 if you held it to the 15 years, right? So that is how much you've actually paid for the property if you held this loan to maturity. Fine. Okay, now let's change these numbers a little bit. Let's go with a 30-year fixed rate mortgage. And now we're going to leave most of the other numbers the same. However, look at your ability, the necessity of qualifying, how that just changed. Let's actually write it down. And you need, let's write down, need $124,000 of income. Okay, income to qualify. All right, now let's change this again to your typical 30-year fixed rate mortgage at 4.5%. And in this case, you need 88.3% or $88,300 to qualify for this $450,000 home. Now, if you keep this to maturity, you're going to be paying somewhere around $738,000 for this house. $738,000 in 30 years is how much you're going to be paying for this house over that lifetime. Okay. Now let's go with a 40-year mortgage. So 40-year mortgage. Oh, and your payment dropped to, what was it? Your payment was $2,052. So in this case, you had a $2,557 payment. So you'd have a payment would be here. The payment would be 33.6K. Here, the payment would be about a 2.6K payment. And then now your payment would be about 2052. Oh, no, it would be a little higher. Hold on. The 2.6 is with that's with the 30-year. Okay, let's drop this to 40. There we go. 1821 brings you to about 2.3. Okay, 2.3K payment. You would only need 80.4K to qualify, so about 10% less income to qualify. And your total over that period of time paid for the property would actually be 800 and about $74,000. Okay, $874,000. So now we look at this, and what do we first see when we look at this? The first thing we do is we say, oh my gosh, in order to qualify with lower income, needing just $80,000 of income. So basically a third less from 124 over here. Oh, what we're doing is we're making housing more affordable. This is true. You're making housing more affordable. But in order to make that housing more affordable, you're actually raising how much money people are paying over time, right? Not necessarily. And so, from a real estate investor point of view, the real estate investor is almost always going to choose the 40-year mortgage if they have that option. Wait a minute, Kevin, why would an investor pay more money? That doesn't make sense. Investors usually want less money out, all right? Well, not necessarily. Not necessarily. Because what you're doing over here to an investor is you're changing the cash flow and the leveraged appreciation factor for the property, right? And so take a look at this. If this property rents for $3,000 a month, that's the rent. Well, then, and then we add in property management expenses. Well, over here, you would be sitting at a negative cash flow on the 15-year mortgage. You'd be having a negative cash flow of somewhere around $600. So you'd be negative $600 per month. On the 30-year, you'd be positive $200 a month. And on the 40-year mortgage, your cash flow would end factoring in about this $200 in property management expenses would be around $450. So you'd have higher cash flow, which actually, because this is a fixed rate loan, means you would have more risk with the 15-year loan. But on top of that, you have leveraged appreciation, right? So consider now that you're paying this property down with less of an outlay every single year. On an annual basis, you're putting into the property with the 40-year mortgage, you're putting in 2345 times 12. You're putting in about $28,000 are going into this property. On the 30-year mortgage, rough math here, you're putting in about $31,200 into the property. And on the 15-year mortgage, you're putting in about $43,200. Okay. But now, if you had appreciation, long run appreciation of, let's say, 3%, you can even do the math with 2% if you want. But if you had appreciation of 3%, let's just say, given that this is leveraged appreciation as well, it's quite fantastic. But anyway, we'll talk about that leverage in a moment. Well, anyway, $450,000. $450,000 times appreciation of 3% gives you about $13,500, right? So you've got about $13,500 of appreciation here. But now consider what you've actually put into the property, the total you've put into the property. Well, you put in about 50 to buy it, right? So you put 50 in to buy it. Let's move this to here. You put in 50 to buy it. Your actual cost of the property, since your cash flow offsets how much you're really putting into it right here, right? Your cash flow here. So how much are you actually putting in? 600 times 12 net. Your net into this property $7,200, offset by your appreciation. 13,500 plus $7,200, not even considering principal pay down, right? Not even considering principal pay down here, your net worth is up $6,300 on the property, just considering cash flow, leveraged appreciation. And that, folks, is on $50,000. So if we divide this number here by $50,000, we're looking at a 12.6% IRR. Okay, but let's do that over here. Well, now we have $200 of cash flow plus the appreciation. So $200 of monthly cash flow. That gives us $2,400 a year plus $13,500 of appreciation on the property. 15,900 Now we've actually gained our net worth by 15.9, which on a leveraged appreciation point of view is actually now 31.8% on 10% down. It gets ridiculous when you only put 10% down, but it shows you how remarkable that leveraged appreciation can be. And it does get that ridiculous. This is why buying your home is so phenomenal. And leveraging for as long as possible with a fixed rate loan is so incredible. But now let's go ridiculous here. And let's take a 450, and this assumes you live there for the first year and rent it out thereafter, right? $5,400 plus leveraged depreciation of $13,500, $18,900 into $50,000 is a 37.8% rate of return. That's your IRR for the first few years, right? Now, that IRR goes down as you then reapply that to your next year of the net worth that you're into the property, right? Because for the second year that you're into the property, now you're into the property $50,000 plus that $18,900 of wealth that you've created. But you can also be ridiculous here, and you could offset this by principal pay down. Every month, you're paying down another $300 in principal on the 40-year mortgage. So you could be even more ridiculous over here. The point is, when you're leveraging real estate, you tend to have a much higher internal rate of return than your interest rate. And so when we look at the time value of money, and this is where I'm going to sort of summarize this and make this a little bit more clear, because I know sometimes it can be a little confusing. When we look at the time value of money, if your internal rate of return exceeds the interest rate that you're paying, you should always make that choice, because your net present value, which is just a finance way of saying is a good decision, your net present value is positive. When your net present value is positive, you win and you want to do more of that. Think about that. If you're paying a fixed interest rate of 4%, but you're actually earning 5% on your money, well, that generally gives you a net positive of 0.5%. That might not be worth it, right? But if you have an internal rate of return of 12%, because you continue reinvesting into real estate, you continue buying rental property, which you can do. An internal rate of return of 12% is pretty realistic in real estate. No company can guarantee that to you, but it's pretty realistic, because what you do over time to repeat the process is you continue to refinance as you have sort of longer term leverage appreciation. You refinance, you buy another rental property. How can you add fuel to this fire and potentially look at a 15, 16, 17% or more rate of return? You buy wedge deals. You buy a wedge deal. You finance properties for the long term. You get leveraged appreciation and a wedge deal over the long term. Your interest, your net present value is substantially higher than the interest you're paying on the loan. So anybody who simplistically tells you that, oh, well, you're actually paying more for the property, Kevin. Why are you paying more for the property? Well, it's because the government is trying to screw you. They're trying to get you to pay more to the banks. First of all, that's a lie. You don't pay this interest to the banks. Like, people need to wake up and realize this money doesn't go to the banks. This interest you're paying goes to mortgage backed security holders, not the banks. Now, yes, a lot of banks hold mortgage backed securities, but guess who holds most mortgage backed securities? Individuals, pension funds, other individuals. Big banks right now, the biggest banks, Chase, JP Morgan, Chase, Bank of America, they hold like 7% of their balance sheet in commercial mortgage-backed securities. It's nominal. Most mortgage-backed securities are held not by large institutions. But the interest you're paying isn't the bank. It's the mortgage-backed security holder. That's important to remember. But beyond that, it doesn't really matter whom you're trying to stick it to by paying lower interest. This is the flawed number to look at. Looking at your total interest paid is the wrong financial metric for evaluating whether what you're doing is a good decision or a bad decision. And unfortunately, that's because in America and widely around the world, most people have not been taught true financial analysis. And anybody who, and I want you to think about it this way, anybody who says, oh my gosh, you're going to be paying X dollars over the life of that loan for an appreciating asset like real estate is missing the point of how wonderful real estate is. They don't understand real estate investing. So when I see that drama on Twitter, I just laugh, and it helps me realize, We are going to be able to create a multi-billion dollar company because people just don't realize how simple and easy real estate is. Now, that's different for a car. Of course, should cars have a 10-year mortgage? No. You should buy a used car and pay it off in cash. It's totally different. Very, very, very different. Now, some people, like Deeps here in the chat, is questioning appreciation versus inflation. Generally, real estate appreciates at a higher rate than the rate of inflation. But at bare minimum, you're protected uh, from inflation with owning real estate, generally. Not this hyperinflation that we've seen in this last cycle, but generally long-term average inflation. We tend to be protected by owning assets. And then, of course, when people say, "Oh, what about the maintenance of a property?" Well, that's purposefully why I built in an additional $200 per month for maintenance and management. Especially if you manage the properties yourself. I mean, think about it. $2,400 buys you a new furnace every year. $2,400 for 4 years buys you a new roof. $2,400 buys you 5 new stoves for just 1 year. It buys you 2 new water heaters. You see what I'm saying? Like, you can maintain a property on a $2,400 budget per month. So that's not terribly unrealistic. I already built that in. So the beautiful thing now, what you can do is you could use buy now, pay later to join the programs on building your wealth. I'll link down below. Use that coupon code before April 12th when the coupon code will be expiring. So one positive dude says a 40-year mortgage will take you 25 years to pay more principal and interest. Who cares? That does not matter. In fact, most sophisticated investors don't pay any principal on their real estate. They actually take an interest-only loan. In other words, by taking an interest-only loan, you're not actually doing a 30-year mortgage or a 15-year mortgage or a 40-year mortgage. Guess what you're signing up for? You're signing up for an infinite mortgage. Why do you think investors do interest-only loans? Because they don't want to pay off the debt. Paying off principal is not the best use of capital. It increases your safety net, but paying off principal is not the best use of capital. If you're putting your hat on, actually telling yourself that you're going to hold a loan for more than 3 to 5 years, you're somebody who's either facing retirement or not financially literate in real estate. And that's okay. That's not designed to be offensive. It's just designed to be realistic. Most people refinance after 3 to 5 years and they reset the amortization schedule anyway. Somebody who says they're going to hold a 30-year mortgage for 15 years so they can finally start paying off more principal and interest. Actually, I think that flip point is somewhere around year 11. They're lying to themselves. They're not. They're going to refinance. Now, hopefully they don't refinance and buy garbage like a Boxable or an RV, which is basically the same thing, or spend money on a vacation, which I'm a big fan of spending money on vacations. Just don't think you should refinance your house to do that. That's financially illiterate. So nobody ever holds a loan to the full term. That's stupid. It's stupid to do that unless you're retired. If you are going into retirement, you're in a different situation. If you're growing your wealth, you don't hold your loan to term. If you are going into retirement, you should pay off your debts. You should pay off everything. Get a 15-year mortgage, make an extra payment, make an extra 2 payments a year, pay that sucker off as much as possible because you want to go into retirement, you want dividend stocks, and pay off your loans. But if you're trying to build your wealth, you don't build your wealth with a 15-year loan and making extra payments. That's nonsense. So, rant over. Thank you so very much for being here. I appreciate you all. I will be leaving now. Goodbye.